What's going on, and welcome on into today's video. Today we're diving into a free indicator here on TradingView, and an indicator that you can find on many trading and charting platforms that we can use to help tremendously in evaluating market strength. And what we can take advantage from that can be extremely useful in the confirmation of a move or not that we're seeing in an underlying market. Now, by the end of this video, you'll have another tool to add to your trading and investing arsenal, and we hope this video can be a great resource for you here today and for many others to come. First things first, I do want to thank the sponsor of today's video, Kalshi. Kalshi is the first fully regulated financial exchange that allows you to trade a new type of asset class, event contracts. With event contracts, you can trade directly on a variety of economic and financial factors, including what inflation will be, how federal interest rates will change, whether the debt ceiling will be raised, or if TikTok will be banned. Kalshi has hundreds of contracts, including more traditional assets like contracts on the S&P, NASDAQ, as well as Forex markets. They have 0 data expirations, daily, weekly, monthly, and even yearly contracts. Kalshi's event contracts can help you protect your portfolio by hedging against specific risks or allow you to profit from being right about where the world is heading in targeted ways. Embrace the future of trading by signing up for Kalshi and using the link below, or visit kalshi.com/TC. That is kalshi.com/TC to claim your $15 credit now. Again, kalshi.com/TC to get your $15 credit now. All right, awesome. So right now we are looking at SPY, the S&P 500 ETF on our screen. And what we're going to go ahead and do is we're using TradingView. Any links, resources such as the sponsor of today's video and things that we use will be in the video description box down below if you want to refer to that. We're using TradingView here as our tool, our charting platform. So we're going to show you how it works here, but you can also find this indicator on other platforms as well. We want to make sure you have an understanding as to how to use it, and then some examples in how it's been useful and how it may be useful right now. So go to the indicator section. As I scroll down, I'm going to go to technicals, click on indicators. It's going to be one of the first ones in alphabetical order. So what we're looking at is called the ADR or the ADL. And we'll show you the ADR and then we'll dive into the ADL. And why that's important is because one could be more useful than the other. It just depends upon what you visually like. And we'll show you kind of how both work. And what that is the advance decline ratio. So really quick, what even is this? What it's really doing is it's analyzing market breadth. And so what market breadth is, it's really kind of seeing what's under the surface, like what's happening inside the market, and showing you the number of stocks advancing or declining on a given day. So like the overall market might be up. And why could that happen? Well, because the overall market is really composed of a bunch of stocks that have some big heavy weights, right? Yet there could be a lot of stocks that have lower or smaller weightings in the S&P and whatnot that are moving in the opposite direction, right? So understanding what's going on under the surface could give us a better understanding of the health of the market, right? If only, a handful of stocks are pushing higher, but everything else is dropping off, that might not be as strong of a market as it looks on the surface by looking at the S&P. Right? So that's what's important about that's one of the important takeaways of understanding the ADR. Now, at the same time, the ADR can also be used to identify overbought and oversold. And what do we mean by that? Well, if we have a huge spike or a huge dip, a huge trough, well, a huge spike could be overbought, and a huge trough could be oversold. Now, in terms of how we visually see this, what's important to take away is what you want to take away what you can visually see and then implement in your own trading and investing understanding and potentially moves that you make. So if you can't, if you look at the ADR and you're like, I don't know, I can't see this. But if you look at the ADL, which we'll show you what those are in a second, and that makes a lot more sense, then please, by all means, use the ADL. But they can both be used in tandem. And I don't want to say that they're interchangeable because they are going to look different. But they both essentially are doing similar things, just showing you in a different visual way. So it's the ADR, the advanced decline ratio, and then the ADL. So I got them on my screen pulled up already. So I'm going to go ahead and do is I'm going to pop open my ADR. And that's this, the bottom of our screen. Okay, so we have the S&P 500 here at the top, which has been, as I'm filming, in a consolidation for quite some time. It's starting to push higher right now. We can even see that by today's ADR, indicating that we've got a lot of advancers. So a higher number here is telling us we got a lot more advancers. Okay, and a lower number below 1 is telling us that we actually have more declining stocks than advancing stocks. Okay, so this scale, this y-axis, isn't like super visually helpful because I'm like, well, it doesn't, like, I can't really tell, it goes up to 4, even see some numbers past 4. You'll have to kind of zoom this in if you want to kind of get a better picture, or adjust the zoom of your y-axis if you want to get a better picture of the ADR. That's just one of those kind of quirks to it that, just pay attention to. You'll see that on the y-axis, you have this 373 that indicates like the current ratio right now. And so that ratio is really how many stocks are advancing divided by how many stocks are declining. Essentially, in a nutshell, like that's what you're looking at. And so you can see that so many more stocks are advancing than declining, indicated by, a 3+ number. If that number was, 1, we're kind of half and half. If that number was 2, okay, we got double the amount of stocks advancing than declining. Okay, that's kind of what you want to be taking away. And of course, the exact same thing on the other side. When that number goes down, right, that's telling us that we have a lot more declining stocks, and that goes below 1 than advancing stocks. And so what do we see? Like, what are the takeaways here? Well, we got some spikes to the upside, but we can kind of tell is that we've been hanging out a lot down in here. And what I'm going to go ahead and do is I'm going to draw a line. Okay, I'm going to go on my TradingView platform. I'm going to draw a ray. And I'm going to draw that line. I guess I can just draw a horizontal line here. I'm going to draw that line at exactly 1.0. So there it is. Okay. So when we are down in here or below this line, we have a situation where more stocks are declining than advancing. And what do we see? That, like, yeah, we've had this consolidation, but a lot of this consolidation outside of a couple of days, really a couple of days that spiked up, okay, we've been kind of just hanging out with more stocks declining than advancing, yet the market's kind of just sitting flat. And that's showing us that we may have a lot of strength, or a lot of this market's being held up by a couple of key stocks, and that's exactly what's happening. We've actually seen, as of late in this period, a lot of the big tech stocks, the Apples, the Amazons, the Googles, these heavy weights in the S&P have been the ones that have been strong as of late, and that's contributing to this consolidation, despite, having a lot of days in here, a lot of time where we've got, a advanced decline ratio that's under 1. Okay. Now let's take this up a notch and see if we can get a better visual here on the advanced decline ratio. So I'm going to go to the ADL. Okay. Here's the ADL now at the bottom of our screen. This is like, whoa, this is the advanced decline line. So what you want to know about the ADL is that it's all about trends. And so I'll give you a brief look into exactly here if you want to screenshot your screen and whatnot, but you can find this on TradingView as well if you want to dive deeper. But this advanced decline line, essentially, if it's sloping down, it means more stocks are declining. If it's sloping up, it means more stocks are advancing than declining. Okay, in a nutshell. So that's what's important to take away. And so what are we seeing and what we can kind of tell? So like this top ADR might not have been super helpful, but I kind of just unpacked it by drawing that line at 1 and saying, hey, we got a lot of days below here and a couple spikes. What do we see? We are in a downtrend here on the ADL. It's pretty clear, guys. I mean, you can see lower highs on this line and lower lows building on this line. So over the past few weeks and maybe the past month or two now, or past month or so, what we see is that more stocks have been declining than advancing in this period. And the exact opposite was prior to that. We had more stocks advancing than declining. And so what's interesting is that despite this period right here, which is pretty clean, right? We've got a trend up. Market also, let me get rid of this. Market also was trending up during that same time span. Wasn't as clear on the ADR. The ADL down here was very clear. Okay. Now, what's happening as of late? Well, we've got a clear downtrend on the ADL, but we just got sideways action. So that's just, again, showing you that we haven't had a lot of overall market strength outside of the stocks that really control or are heavy weights in the S&P. Like that's what that's telling us. That's what that's showing us as of late. And the exact same thing could happen on the flip side. So for example, if we see an ADL that happens to be trending higher, but the market's kind of flat, what that's telling us is that the big name tech stocks or the big name, weights in the S&P, for example, the mega cap stocks might actually be weak, whereas the rest of the market, maybe more the risk on stocks, the riskier stocks, the lesser flight to safety names, if you will. And maybe some don't even believe that in the case as of now because of valuations and whatnot, but that's kind of maybe more small caps, maybe more mid caps, not these mega cap techs. Those are stronger. So that's the correlation, okay? Now, how does that help you? Well, that's very, very helpful because now you can understand where there's better deals or where things could be overbought or oversold. So in this situation right now, what you're seeing is that there are probably, if the market's going to continue higher and we've got higher lows, well, where are you going to find deals? You're not going to find deals in the stocks that have been strong as of late because this indicator is telling us that there's actually been a lot more stocks under the surface that have been trending down as of late and declining over the past month. Whereas if the market's staying flat, but more stocks are declining, then the better deals may actually be outside of those big names that are holding things up. So that's the biggest takeaway from looking at this indicator, especially as of late. And again, you can find these correlations and all this stuff at different times and on different time scales, but that's the biggest takeaway from using the ADR or the ADL. In our case, personally, I'm a big fan of the ADL over the ADR, but it's always a good idea to have an understanding of the ADR, the advanced decline ratio first, before we dive into the ADL. And so that's why we cover it that way. Hopefully this video helps you guys out. Make sure to check out Kalshi, the sponsor of today's video, and the other links, resources down below. And we'll see you guys in the next one. Peace.